new GDP data shows the U.S. economy rebounded 3% in the second quarter. That's better than the 2.3% estimate and reverses last quarter's 0.5% decline. The Commerce Department says the first quarter drop was mainly caused by a surge in imports. And the Federal Reserve is expected to leave interest rates unchanged today against President Trump's wishes. The Federal Reserve is expected to leave interest rates flat against President Trump's wishes. Again, the Fed itself is increasingly divided, with some speculating two board members could dissent in favor of cutting rates, as the president has been calling for. But Fed Chair Jerome Powell and others have signaled they still want to wait and see how inflationary tariffs will be. Bankrate chief financial analyst Greg McBride is here with more on that. So, Greg, you're predicting the Fed will hold rates, but also that there will be some, you say, well-telegraphed dissent. Why? What do you mean by that?
Well, I think we're going to see a greater extent of dissent than we've seen in quite some time. If we get two voters that vote for a rate cut, it's going to be the first time there have been two Fed governors dissent in almost 32 years. So that in and of itself is significant. The reason it's well telegraphed is that we know for a fact one will vote for a rate cut at this meeting. He's basically said so publicly, and reporting has said that he has also informed Fed Chair Powell of his intention to vote for a rate cut. So we know it's coming. It's not necessarily going to come as a shock, but what it will do is, I think, put the Fed under an even greater microscope in the months ahead.
So does the president have a point here? For the most part, jobs reports and inflation reports have been better than expected the past few months. Does that warrant a rate cut?
There's nothing in the economic fundamentals that screams rate cut right now. Unemployment's still low. It's about 4.1%. Inflation still higher than desired. It's closer to 3% than 2%. And the economy is still growing. The question is, you have to skate to where the puck is going to be. Where is the economic puck going to be in a few months? How much slowing will we see in the labor market? What is going to happen with inflation and the tariffs? And because there's so much uncertainty there, the Fed just wants more time and, importantly, more data to evaluate before they commit to their next move in rates. So it's not coming today. Maybe it comes in September. Ultimately, that's going to be dictated by what we see in the economic data.
Now, we keep hearing about the uncertainty around looming tariffs. So what happens if the picture is still uncertain in September? Will they hold rates indefinitely?
It depends really at that point, I think, on the health of the labor market. If the labor market is still holding up, we're kind of in this stalemate, no hire, no fire type labor market right now. We're seeing slight job growth. It's really decelerated, but companies are by and large hanging on to people and not laying off a lot of people. We still see initial unemployment claims at really low levels. If that changes, that's the type of thing that would be a catalyst for the Fed to get off the sidelines and start cutting interest rates, even if there's still ambiguity on the inflationary front.
So what should the rest of us be doing in the meantime?
Interest rates are high, Diane, and even once the Fed resumes cutting rates, they're still going to be high. So it's costly to be a borrower, but it's good to be a saver. Lean into that. Pay down high-cost debt, credit card debt in particular, but even a lot of those home equity lines are carrying double-digit interest rates. Pay that debt down, and then also boost your emergency savings. High-yield savings accounts are still paying well over 4%. That's ahead of the rate of inflation. If you have less debt and more savings, you're then better able to weather whatever the economy may throw at us.
Bankrate chief financial analyst Greg McBride, thank you.